Vincent. Today is Saturday, June 25th, 2011, and this is the introduction to the BullBear market report for BullBear traders members. And this portion, as I've been doing for the last few weeks, is also going to be for the general public due to the potential for a significant break in world financial markets, and I'd like to share at least some of my analysis, my base analysis, my core analysis with the general public for your benefit. So what we've been doing for the last few weeks is looking at the basic technical condition of the major stock and commodity markets, and we're looking at the major trend lines from the March 2009 low, the relationship between price and those trend lines, the relationship between price and horizontal support areas, between price and the major moving averages, the 50, 20, and 200-day exponential moving averages, and the relationship between price and recent major highs and lows, like the April 2010 high and the November 2010 high and the March 2011 low. So we'll continue doing that with our charts today, and we'll start off with the S&P 500 weekly chart. So here's the weekly chart of the S&P 500, the major stock index for big capitalization U.S. stocks. And we can see that, as I've been talking about for the last few weeks, it's resting right now upon the uptrend from the March 2009 low. And this is critical support here. This also corresponds with the 200-day moving average. It's just a few points above the 200-day moving average. And you can see not very far above the 50-week moving average, which is also key long-term support. So we are sitting in a position where S&P 500 could break a significant support soon. Looking at the last two weekly candlesticks, we can see these long wicks, and that means that there's selling pressure up in here. Every time the market gets up there, boom, it gets hit with a wave of selling, which shows me that this is more than likely going to break to the downside, and very, very soon, probably immediately at the beginning of next week. And it's also very close to the March 2011 low as well, which would be another break of support. It would come very quickly into the 2010 highs in November and April. So that's the picture in the S&P 500. And let's look at the New York Stock Exchange. Now this is the daily chart, and you can see that the NYSE closed below its 200-day moving average and right on that trend line from March 2009. And not very far above its March 2011 lows. I also want to point out that there was a very big volume stick on Friday, and that could be the sign of a low, of a capitulation low, but when we look at the rest of our technical indicators, it doesn't lead me to believe that this is a capitulation spike in volume. What it is an initiation spike in volume. That means the selling has now finally just begun. It has not ended in a bottom. It has just started to begin. And that's my interpretation at this time anyway. This is the NASDAQ 100 futures contract, and it also closed below its 200-day moving average, just barely above its support of the uptrend from March 2009. And also want to point out that several times it has penetrated the March 2011 low as well as the November 2010 high. So we're seeing a little bit of relative weakness in the formerly leading technology sector, which is not what you'd be looking for in a bullish situation. Looking at the New York World Leaders Index, which is basically an index of all the world's leading stocks, we're seeing a similar situation. It is now below its 50-week moving average. It closed right on top of its uptrend from the March 2009 low. So what we're seeing right now in all of these major is the possibility that if we open weekly on Monday morning, we could gap down below these support levels. And if you gap support levels, then you have lots of stops set by traders and investors below those important support levels, which could be then triggered and could initiate a cascading of selling from these levels. And here's the New York World Leaders Index on a daily chart, where you see that it's well below its 200-day move, with the 50 and the 20 descending really rapidly. And this kind of configuration, especially when it's coming right at a very key support level, as you can see, you've got your uptrend, you've got some horizontal support, from former highs and lows, as you can see right in here. When you have this kind of configuration of moving averages and support levels, it usually augurs a very rapid decline from there, a very large break of support, and that can correlate with a potential crash. Now let's look at the Dow Jones World Index, and we can see that it's broken its uptrend from the March 2009 low, and it's sitting right on top of its 200-day moving average. And it came down, it broke that, and it came back and retested the break. So this is another indication that things break down. And as I said last week, sitting very precariously now below support instead of on top of support. This is the EFA, which is the ETF for the EFI index, and that's Europe, Australasia, and the Far East. So the developed world excluding the US and Canada, and it has broken support, as you can see, with a strong red candlestick from last week. So it's below its 50-week moving average, which is starting to curl over. So we have broken support. Last week we were talking about sitting on just barely above support. This week we're seeing breaks of support. Same thing for the Euro Stoxx 50, the European Big Cap Index, closed down in here, broke support below its moving averages. Now you've got the 50-day moving average crossing below the 200-day moving average for a bearish cross. This is coming as it's breaking down below major support. You have the Bovespa, which is Brazil. Again, this is supposed to be one of the leading economies in the world, one of the economies that is going to help us grow out of this recession, and it has broken support, as you can see. We're looking at Italy now. Italy last week as probably one of the next countries to have its sovereign debt crisis come onto the front burner. And what happened? Well, we've got a break of support. You can see this pretty clearly here. Let's look at FXI, which is the ETF for the China 25. And this is essentially the Dow Jones of the Chinese stocks, the big cap Chinese stocks, and it has clearly broken support here as well. And let's look at the Shanghai Composite itself. Now, interesting thing about Shanghai is that it broke support, a couple of different levels of support here, but it did have a nice rally last week. Following the news on Greece getting an austerity package together, it rallied back up. Now, it broke and then rallied back to the break. So that's fairly common that you'll see this happen. You do the break and then the rally back to the break. So that may not necessarily be a bullish thing unless it carries through strongly on Monday, Tuesday. Now here is the Bombay Sensex, which also broke but rallied back into the break. So again, that may be bullish if it continues, especially if it were able to get above this 50 and 20-week moving averages here. That could potentially be bullish. But then again, it's fairly common for these breaks to be retested, and that may be all there is to that. Same thing with Apple. Apple had a very serious breakdown here, and then it rallied back to inside of the range again. But it was pretty weak again on Friday. So unless it gets this 50-day moving average pretty quickly, I would have to say this is just a retest of the break. Junk bonds. This is the ETF for junk bonds. Also had a big break and then it come back up, retest the break. Again, just to reiterate, that's not necessarily a bullish thing. Just part of the process of topping. This is CCI, which is the commodities index. It's come down and is testing really important support. It's looking ready to break lower after A, B, then 1, 2, and looks like it's starting 3 of C down now. This is the agriculture index, so an important break of support here, below the moving average, below the horizontal support. This is the crude oil. Okay, important break below the 200-day moving average, a retest of the break, and then a new failure. Here we have gold, an important break of an uptrend, a strong uptrend at the end of the week, closing below its 50-day moving average. And this is happening as the dollar is breaking out. So it looks like we've reached a long-term top for gold. This is silver breaking down out of a long-term uptrend channel here, as well as a short-term triangle. Very strong break at the end of the week as the dollar was breaking out. This is the metals ETF, the DBB. Also, this includes copper. So below its 200-day moving average, the moving averages are rolling over. It's sitting right on this very key support level. As you can see, a confluence of support, very ready to break down from there. So once again, we have markets either teetering on the edge of support or having already broken support. And we're in a situation where you're not getting any recognition of that. This is what I'm showing you here is pretty much basic technical analysis of markets. These are the basic criteria that you look at. And people are not looking at this. They're looking at other things like sentiment, which they consider to be overly bullish, excessively bearish. They're looking at things like short-term oversold conditions. What I'm looking at is long-term trend line and support breaks in the progress of happening. And the fact that nobody's looking at it or willing to recognize it makes a crash resulting from this even more likely. And I'm not guaranteeing or promising a crash. I'm just telling you that the setup for one is there. Whether it comes to fruition or not, I certainly couldn't tell you. Okay, this is Stephen Vincent from thebullbear.com. To get my full analysis, join thebullbear.com and then join the BullBear Traders Room at thebullbear.com, and you'll get the full analysis. And I promise to help to keep you on the right side of the markets.